Hello everyone, George DeSantis here with a look at the market for the week ending Friday, December 28th, 2018. And as usual, before we get into the stock charts, etc., take a look at the disclaimer and simply note that these videos that I do really for my own personal edification, and I put it on YouTube, and if others want to take a look, they do so, but it's by no means an attempt to give professional investment advice, since, as the disclaimer here says, I'm not a professional investment advisor. So I thought we would start by looking at the monthly chart of the S&P 500. And let's note a few things here. For those who are new to technical analysis, and it's all gibberish for them, let me point out that each one of these bars represents a month's data. So in this case, this bar here is December's data. The high, the low for the month so far, the open for the month, and the close for the month, okay, so far. And each bar represents 1 month's data. Now, we see the moving averages here. We see the 4-month, in this case, exponential moving average just crossed below the 9-month exponential moving average. Not a good sign. Clearly, everyone knows we are in or approaching bear market territory, 20% down, from the high, recent high. In any case, another thing to note is that the 50-month moving average, this magenta line, okay, seems to have been hit by the low of this bar of December, just a little below it actually. And when we look at the Fibonacci retracements, which I did from the low of 2016, February of 2016, to the high here in September, when we plot this line and we look at the Fibonacci retracements, we find that, let me put it back exactly there, we find that this bar seems to be hitting the 50% line or 50% retracement level. Now, I've heard it said over the years that oftentimes on a correction, which this may be more than just a correction, we don't know yet. We find these things out after the fact. But corrections usually end somewhere around here, and especially between the 50 and the 618, the golden rule, retracement level. And that would be between this level here, between these two levels rather. Okay? So we don't know whether we'll go any further down from here. We don't know that yet. If we are in a bear market, might just go further down. We might come all the way down somewhere here. But we have to wait and see. Now, when we go to MACD, we could see that MACD was losing strength here. And not quite a classic bullish, bearish divergence, because we didn't go below the zero line here. But in any case, the bears are in charge. The bears are pulling the bulls below the water line, the zero line here. Below the level of the water, bears are pulling the bulls down. That's Alex's analogy or metaphor. The volume is just a little above normal here, or average. So the monthly chart, no doubt, shows us that we have a pretty bearish bar here, and that's no news really to any of us who've been watching it. And now we take a look at the weekly chart of the S&P 500. And I left the Fibonacci retracements here, and you can see that this is the 50% line, and prices came all the way down, all the way to touch and go a little below the 50% line. And in fact, it just seems to have hit exactly the 200-day week, in this case, 200-week moving average. This white line here is a 200-week moving average. So it just hit that. Hey, does that mean that we're going to find support at the 200-week moving average? One never knows, do one? But if you look at the moving averages, certainly we see the breakdown here when the 4-week exponential moving average crossed below the 9, which is the red line, and they both cross below the 30 weighted moving average and so on. And you get this cascade or waterfall of prices. All right. Interesting to note, another interesting fact to note is that 2 weeks ago, not last week, but 2 weeks ago, the volume was pretty high. This bar here was printed on very high volume, more than the average. You see, the average line is here, the mean line. Last week, however, it's a holiday period. The market rallied a bit, quite a bit, but it didn't do so on high volume. So that leaves the traders and investors questioning whether this isn't just a bear cat bounce, and so that may be the case, and we'll go low. We could very well go lower from here, break below the 200-day average. If we did that, there's a lot more pain ahead, and certainly we don't know what's going to occur. But what we're doing is taking a look and see what's possible here, and what we are likely to see. So we can hope is not the strategy, but we can hope that we hold at the 200-day and continue to rally up. But even if we get a rally from here, we're going to have a lot of overhead resistance, as it's called. You see the 30 weighted moving average here is at 27.33 approximately. Okay, the 50-day just below that, 2700 approximately. So there'll be a lot of resistance up here. So this is going to be a trader's market for a while. And if you can't stomach the drawdowns, etc., you might not want to be holding too many stocks or a lot of stocks throughout this bear market. Let's take a look at the daily chart. And here's a daily chart of the S&P 500. We can see those moving averages. In this case, it's a 4-day exponential moving average, the yellow line, and you could see when they crossed the 30 weighted moving average here, both the 4-day and the 9-day exponential moving averages crossed below the 30 weighted moving average, and this was where a lot more pain occurred after this false breakout. So that was in the early part of December. Now we hit that 50% retracement level, and we had a piercing bar, a bullish bar, another bullish bar, and the 4-day turned around but hasn't quite crossed above the 9 exponential moving average. Friday was closing a little lower than it opened. This isn't a doji, which means the price could go either direction. On a doji, it can go in either direction. But again, you see the overhead resistance right here at 25.76 or so, and another at the 50-day, which would be 26.55. So if you're trading, be aware of the fact that you're going to get resistance here, and be prepared to take profits if you wish. That's what I do anyway. I'll be trading stocks, Now, looking at the MACD histogram trended up quite a bit as this market moved up a bit. We got a little bit of a rally last week. And so this is an attempt by the bulls to drag the bears back above the waterline, the surface of the water, the zero line, okay? Using Alex's metaphor of the bears and bulls pulling each other up and down above this level here, this water level. You could see how the volume was very high in this case here. Is that a capitulation? Maybe it was capitulation. And if it was capitulation, maybe this rally will continue for a little longer than many people expect. We'll see. We'll see. Let's turn to some individual stocks. How about starting out with the big kahuna, Apple? Now, you can see that some time ago, well, let's see, that was back in the early part of 18, in August of 18 actually, we had a high here, we had a higher high here, but we had this divergence of MACD a lower high of MACD after the bears broke the back of the bulls here. So we had this divergence, and since then the market, of course, went all the way down. Now, interesting enough, we have the reverse, it seems to me. We have a low and a lower low. We have a low of MACD. The bulls broke the back of the bears here, okay? MACD became positive. The bulls made a very valiant effort here. And then the bears pulled them down again below the level of the water. But when they did, the bears lost a lot of their strength. So we have this lower low and we have this higher low of MACD. Since then, Apple has given us what is called a bullish morning star, a very bearish candle, a doji, and a bullish candle. And it actually engulfs this candle here. So Apple is looking like a possible buy again. Unless, of course, the whole market is going down further and Apple takes a hit with it. Because many people consider Apple, and I do too. Apple is one of those stocks that tracks the rest of the market, or vice versa. So watch Apple, because we have a bullish divergence of MACD. Some of you will remember that in 2016 we had 2 consecutive divergences, bullish divergences of MACD, and that was when Apple was selling at around $100 a share. That's when I bought it. That's when I think some of you bought it too. Some of you still have it. I chose to sell it in here, somewhere in here, when this breakdown started to occur. But I'm looking to buy it back again if we continue, and especially if we get the 4 crossing above the 9, and we get more of this confirmation of an uptrend, and MACD continues to trend up, I'll look to buy it again. Now, I did buy some stocks on Wednesday, that very volatile day when the market Dow closed up over 1,000 points. And let me show you some of the rationale for buying, but small quantities. I'm not all in, I'm not getting too bullish here, let's face it. But Workday is one, and you can see that Workday found support around the 50-day moving average, and we have this nice morning star formation. I like Workday. I loved it for a while. I owned it all the way into here, and then I got rid of it somewhere in there. So Workday is one. Another one is Etsy. Now it did break down here, hit the lower Bollinger Band. MACD is trending up again, but I like this morning star formation. I used to own it. I sold it at a gain. Here's one I bought a small amount of, Procter & Gamble. You can see that it had a bearish divergence of MACD here and took this fall, and now it's trending up. And you can see we have an inside bar, or bullish harami, and it seems like it's looking to trend up again. So I bought some of that, a little bit of it. Here's Salesforce. Now I love Salesforce, but it had this fall here, and then we had this bullish divergence of MACD, and it rallied up. But since then it's come down with the rest of the market, and now we have a nice morning star formation. Look at the 4 crossing above the 9. I like that. And MACD trending up from below the 0 line. So I have some of the Salesforce again. Another one that I bought some of is Netflix. Now I used to own Netflix way back when, but what I'm seeing here is 2 consecutive bullish divergences, just like we saw on Apple back in 2016. So I like this, and I bought some. Here's Intel daily chart. You can see that morning star formation here, and the 4 is looking to cross above the 9. Well, of course, I could hope so. MACD is trending up. I like that. They simply seem to be signing a new contract with Israel. I think we're running out of time. I have to say a quick goodbye. Have a nice weekend. Happy holidays to you again.